This year we've been quite optimistic about the sort of returns investors could get from markets. Just lately we've become a bit more cautious. The volatility we saw earlier this month could have been a bit of a warning of the sort of risks that are increasing, and as a result we're starting to recommend to investors that they reduce some of their positioning in shares and lift their sort of funds in cash for the time being, but still be quite strongly invested in fixed income or bonds. The US economy finally seems to be starting to slow to a more subdued rate of growth. Of course, inflation has also come down quite a lot, and Federal Reserve, the US Central Bank, is indicating they'll be lowering interest rates. Even if a recession can be avoided, slower growth can still create a bit of unease. The other aspect is that the US stock market is at a pretty high level. The S&P 500's risen 25% over the past 12 months. Share prices are quite high relative to where they've been over the past few decades and don't seem to be factoring in that potentially slower rate of growth. In many respects, Australia is not all that different. The main difference is inflation's coming down a bit more slowly, and that's likely to mean interest rates also come down a bit later. The US dollar could be weaker, and that would be another potential constraint on returns in international shares. If there is a bit of a correction over the coming months, it could provide an opportunity to get back into shares at a more attractive valuation. But for the time being, we're inclined to think those risks are yet to materialise and could come forward. We would suggest for now being a bit more invested in cash, still quite strongly invested in bonds, which should benefit from falling interest rates, but a bit more cautious on shares, particularly international shares.